the world. Well, thank you all very much indeed for joining us today. We are absolutely delighted with the interest that this event has attracted. We have, if everyone turns up, at least registrations, we have something well in excess of 200 people who have registered for this discussion today. And many of these people are from the US, which shows that there is interest in Europe from US managers. My name is Simon Osborne. I am the CEO and editor-in-chief of IFI Global, which is a research and media house based in the City of London. We focus on the alternative side of the fund management business, particularly on fund structuring related issues. And we have one publication called FSI, which specializes in providing information to US managers going overseas or coming to Europe. And the anecdotal evidence we have from publishing this, along with the series we've done with Acorian, really does suggest that interest in Europe from the United States is growing. As just mentioned, we've done a number of these events with Acorian. This is the third of a three-part series. And today we are focusing upon the marketing issues that US managers who are looking to come over to the European region should be focusing upon and addressing when they do that. We have on the panel those people listed on the screen here: Lorvin Chandra, CEO of PropTech AM; Paul Ellison, partner of Clifford Chance; Lily Marcel, also a partner at Clifford Chance; Paul Spendiff, who's head of sales fund services at Acorian; and David Walsh, who's partner at Dillon Eustace. So we are going to be particularly focusing on these topics that you will see on the screen. There's an awful lot for us to cover in only an hour's time, so we will try and keep rattling along. We will try and take the odd question potentially as we go along, but we will reserve approximately, say, 10 minutes at the end for questions if we haven't been able to get to your question before then. So we're going to do the market overview, and we're going to be identifying a target audience for US managers, distribution channels, domiciliation, working with placement agents, the regulations, of which there are many, many here in Europe. One in particular bears mentioning on its own, which is the SFDR and the development of ESG here in Europe. And as I said just a second ago, we will have a few minutes at the end for questions. We may well go off script, which in a way I hope we do. We go through the highways and byways, various things might well pop up. And as I say, do please use the Q&A button that you will see at the bottom of your screen. So I'm now going to stop sharing screen. Hopefully the panel will come up. Hooray, they do. We are also going to, and this is my technological challenge of the day. I've done it once before, but I had a colleague of mine help me. We are going to launch a poll. So I'm going to launch this poll now, and then before we get to questions, we will read out the results. So hover this over and hit the launch. There you can see the two questions. Have you launched a fund targeting EU investors? And secondly, are you looking to launch a fund targeting EU investors? So we will leave that on the screen, and then we will come back to that later. Can I ask the panel to all introduce themselves, and then we will get into the subject matter I was referring to earlier. Lily, can I come to you first, please?
Yeah, absolutely. Thank you. So I'm Lily Marcel. I'm a partner in the funds team at Clifford Chance, based in the London office. I focus on fund formation for private fund managers across a whole range of asset classes. So I do infrastructure, private equity, real estate and debt funds. I also follow ESG regulation very closely, and I'll be talking later a bit about SFDR. And I work very closely with Paul Ellison, my partner in the regulatory team, as we're often looking at these questions of how can fund managers domiciled outside of the EU access EU investors.
Thank you. I think we'll go lawyer, non-lawyer, lawyer, non-lawyer, as we have a number of lawyers on the panel today. So Paul Spendiff, can I come to you next and ask for your
Absolutely.
opening from you?
Yeah, sure. So I'm Paul Spendiff. I'm the global head of fund sales for Acorian, which is a financial services group with 280 billion of assets, real assets, across 21 countries. Obviously, Europe's a key focus for us in servicing our US managers. I'm based in the London office, but actually I'm here in a very blue sky, sunny New York, meeting many of them this week.
Thank you. And David, over to you. Presumably you're in Dublin.
No, I'm based in our New York office.
Oh, we have two people on the other side of the pond with us today.
Yeah. Similar to Lily, I'm a funds partner in the asset management practice of Dillon Eustace. For those of you not familiar with Dillon Eustace, we're primarily an Irish law firm. We have offices in Dublin, New York, where I'm based, Cayman, where we practice local law, and Tokyo. We're the #1 advisors to fund promoters in Ireland. We have the largest asset management team in Dublin, and we act for a quarter of all US managers with Irish domiciled funds. Similar to Lily, we advise on product design, authorization, migration, listing, marketing of Irish domiciled funds, full spectrum from traditional UCITS, ETF, money market funds, the full gambit of alternative funds, hedge, real estate, infrastructure, loan, private debt, and more recently, private credit as well. I've been out in our New York office for the last 8 years, helping US managers establish their funds in Dublin.
Thank you. And Lorvin, can I come to you next?
Yeah, hi, my name is Lavin Chandra. I'm the CEO of PropTech AI. We are an artificial intelligence driven capital raising company. We are raising capital for fund managers. 50% of our clients are actually from the US. We are covering 5 core markets in terms of LPs, London family offices, Zurich family offices, institutional investors from DACH, institutional investors from the Nordics, and also Middle Eastern LPs. Because we are an AI-driven company, we have at the moment 5,000 LPs in our system, up to 150 data points of those LPs. And we have also relationships around 800 close LPs in Europe and the Middle East.
Thank you. And the other Paul Ellison.
Thank you, Simon. So I'm Paul Ellison. I'm also, like Lily, a partner in Clifford Chance based in London. I'm in the financial services regulatory team with a particular focus on regulatory issues for fund managers and fund structuring, and including within that some of the issues about international access to the UK and the European markets more generally for fund managers around the world.
Thank you. Right. Well, let's get straight on with it. As I said at the beginning, we have an awful lot to go through and not a huge amount of time to do it. Can we go to Lavin to give us a macro overview of the European markets before we get into any detail?
Yeah, well, in order to identify your target investor group and to attract European capital for US funds, it is quite important to understand key data of European LPs. So let's start with what European LPs think about the current macroeconomic environment. The current market conditions are characterized mainly by higher base rates, inflation, and geopolitical uncertainties. These are pushing investors towards seemingly safer assets and also safer geographies such as Western Europe and the US. On the micro side of things, around 60% of our LPs expect that in 2024, private equity, venture capital, and also real estate will perform worse than in 2023. But it will start to recover towards 2025. And investors seem pessimistic for the short term, but are slightly more positive on a long term. LPs are also slightly more positive towards the following 4 asset classes. So for private debt, our investors seem attracted to the rate dislocations and the opportunity to earn flotation rates on their investments. Infrastructure is seen as a natural inflation hedge, since it can benefit from energy price increases This asset class is also uniquely positioned to benefit from trends like technology advancements in the area of data and telecommunications, and the move towards hybrid work. Hedge funds tend to be favored during times of market uncertainties, as price inefficiencies arise and active management can generate crisis alpha. Natural resources are also viewed as a good inflation hedge due to benefit from natural resource price increases. When we look at asset allocations from family offices only, in 2022 and 2023, those 4 asset classes didn't receive enough attention. Hedge funds had an allocation of 7% from family offices. Private debt had an allocation of only 2% from family offices. Also, natural resources had an allocation of only 2% from family offices. And infrastructure had an allocation of less than 1% from family offices. We believe that allocation towards these asset classes will likely increase in 2024. Also, 90% of our institutional LPs indicated that they will increase or at least maintain their allocation towards infrastructure and private debt in the next 12 months. Roughly 80% of investors said they would increase or maintain their allocations towards hedge funds. Let's speak about the long-term industry outlook, which is actually positive. Allocations towards alternative asset classes have steadily increased to assets under management of around $12 trillion in 2023. In the next 5 years, we are expecting the assets under management of alternative assets to increase to more than $20 trillion. In terms of funds which have been raised, we have reached a peak of nearly $1.6 trillion globally in 2021. In 2023, this number is much lower at around $1.1 trillion. But in the next 5 years, we are expecting that to increase to a mark of $1.6 trillion. So basically the same rate what we have achieved in 2021. Even the asset classes that are not seen in such a positive light today, real estate, private equity, and venture capital in particular, are still expected to increase their assets under management in the long term. In addition, European LPs are expecting great opportunities in the medium term as we begin to see asset price reductions as a result of growing interest rates and reduced competition for deals in that space. For this reason, 2023 and 2024 might prove to be very attractive vintage for these asset classes. When we look at North America only, LPs continue to invest into North America. Around 40% of our European family offices had an allocation towards North America. Globally, this number is even higher, which means nearly 50% of all allocations are in the USA and Canada. 1/3 of our family offices want to increase their allocation, and 2/3 indicated their investments in that region would stay the same. So what does this all mean in order to raise capital in Europe? In 2024, European LPs are looking for safer assets and geographies. Try to capitalize on the market situation. So LP capital can be deployed in 2025 into real estate, private equity, and venture capital. Try to raise capital from European family offices in 2024 and start the capital raising process with institutional investors such as pension funds and insurance companies now in order to complete the due diligence on time when the market is actually picking up. And finally, try to adapt a data-driven approach in order to identify the right country and the type of LP.
Thank you. And you're going to spend a second talking about identifying the target market as a way to segue into that. In terms of those figures you raise well over $1 trillion each year, and you're expecting a big increase. Can you say in terms of investor segments in any European country, does anything particularly in your estimation stand out?
Yeah,
any,
I mean, first
investor class in any country in terms of that growth you're looking at.
So the family office or private wealth industry is growing steadily, and it's an asset class, or it's an investor group where American fund managers should target straight away, because they're the most flexible and actually also the fastest one in terms of due diligence. Their ticket sizes are becoming bigger and bigger. You were anticipating in the past $1 million as a ticket size, but those family offices, some of them have 50 billion assets under management. So target these family offices first, because their allocation will be towards the United States. Then focus on the clusters we have in Europe in terms of family offices, which is London, and which is also Switzerland, or Zurich and Geneva. But on the same time, while you are raising the capital from private wealth, start to speak to institutional investors, because they have also deep pockets. But their due diligence process, especially with a new manager, takes much longer. So you might anticipate between 6 and 9 months to complete an entire due diligence process with a pension fund from the Nordics or from the DACH region.
Thank you. And unless you want to say anything else about from a sort of targeting audience point of view, we'll start moving on to the actual fund structures we have in Europe. So is there anything else you'd like to say there, Lovin?
Well, yeah, so in the past, you didn't have a data-driven approach to raise capital. Now you have the data. So make sure that you're using the data. Then you have a competitive advantage, because it's the same data what European fund managers also have. But if you have an understanding that there's a certain LP looking for a certain asset class, then you want to target that LP first, instead of going out and not knowing from where to start to raise capital from.
Excellent. Thank you very much. David, can I come to you and ask you, there's a panoply of different, and you must spend all day, every day talking to your clients in the US about this, the different types, the ACE, the UCITS, the LTIS, the LTAS, this and the others, and all the other different acronyms we have here in Europe.
Yep.
Can you just give us, can you give an largely American audience some sort of overview of the different legal structures that we have here?
Yeah, absolutely. So, I mean, for any US managers on today who already have funds either in Ireland or Lux, they're going to be pretty familiar, I think, with some of the available structures. So do bear with me as we take I guess a high level look at some of the main legal structures, but also the two principal regulatory structures that we have in Europe. So regulated investment funds currently established within Europe are either going to be UCITS or AIF, using a number of different legal structures. The type of strategy, the asset class, the location of the target market essentially drives the decision of whether you're going to go with a UCITS or an AIF. What I mean when I talk about a UCITS or an AIF, starting with the UCITS, they're essentially mutual funds, very similar to 40 Act funds here in the US. They're designed with the retail consumer in mind, ensuring appropriate levels of protection for investors. The key common aspects of UCITS are that they must be open-ended and they must be liquid. Now, they can be set up as a single fund or as an umbrella fund comprised of several ring-fenced separate sub-funds with separate investment strategies and policies. Each sub-fund, importantly, is treated as a separate entity with its assets and liabilities segregated from those of other sub-funds. Management of each of those sub-funds can be by a different investment manager. Importantly, you can appoint a US investment manager to manage some or all of the sub-funds. UCITS funds are extremely popular. They're used for a wide range of strategies and asset classes. Exchange-traded funds, money market funds are almost exclusively established as UCITS. They've been around since 1985. They're really seen as a gold standard globally. What I see with well-established UCITS domiciled in Dublin is they're becoming increasingly popular in Latin America, in Chile, in Brazil, also continue to be increasingly popular for distribution in Asia, and more recently as well within the Middle East. I know Paul's going to be talking more on kind of distribution and marketing, but just to say that it's a 10 working day registration process to market your fund within the EU. On the alternative side, the legislation governing alternative funds is AFMD. It's been around since it's 2013. It imposes organizational, operational transparency, conduct of business requirements on AIFMs, so alternative investment fund managers and the funds they manage. In Ireland, the central bank permits either a qualifying investor alternative fund or a retail investor fund. The qualifying investor fund, it's a regulated alternative investment fund for well-informed and professional investors. It's not subject to any investment or borrowing restrictions, so it can really be used as the widest range for investment purposes. In relation to getting it established and authorized by the central bank, there's no prior, generally speaking, there's no prior documentation review by the central bank. It's essentially self-certification regime where you file all your documents 3 p.m. the day before you want the fund to be authorized. So really managers are in control of the launch period, depending on how much time it takes to negotiate with the various service providers. That's the qualifying alternative investment fund. There is a retail investment fund option in Ireland as well. It's not particularly popular. It doesn't come with the marketing passport. It's less restrictive than the UCITS, but obviously more restrictive than the qualifying investor fund. That's the distinction between, we'll say, the UCITS, which is the retail, and the alternative funds. Once you've decided if you're going to UCITS or the alternative route, then it's really, certainly within Ireland, you want to think about, from a legal structure perspective, what sort of fund you want. So there's various legal options. You can have a public limited company. You can have what's called the ICAV. It's a corporate structure specifically designed for the investment fund market in Ireland. You can have the limited partnership, which I'm going to be talking about briefly in terms of the updates to the Irish legislation. You could have a unit trust, or you can have a common contractual fund. Purely for timing purposes, I'm not going to get into the features of all of them. I'm just going to briefly touch on the ICAV and the ILP, as we see them increasingly popular structures for private credit strategies in the US going into the ICAV, or more recently, private equity into the ILP. As I said, starting with the ICAV, it's a corporate vehicle. The legislation is specifically drafted and aimed at investment funds, so you're not subject to general pieces of company law that you might be with the PLC. It's very easy to establish, no minimum capital requirements. Similar to UCITS, you could have it formed as an umbrella with multiple segregated cells. It comes with the EU passport eligibility under AFMD if it appoints an EU authorized AIFM. It must appoint an AIFM, which must be regulated, though if it's Irish, there's narrow exceptions, which allows it to be registered for a period of time, which would allow a US manager to temporarily act as AIFM. The AIFM may manage the fund directly, or it may appoint a regulated investment manager, such as a US manager. The ICAV must have a board of directors, 2 of whom must be Irish resident. It must appoint a local depository or an admin, unless the AIFM itself comes with an admin function. As I mentioned, in Ireland, we do see recently a lot of private credit strategies going into the ICAV. The US managers availing of the US-Ireland double taxation treaty to solve the tax challenges associated with US lending in respect of an investment fund. Very briefly, just to quickly touch on the Irish ILP. Some of you may be familiar with it or have heard about it. It's the Anglo-Saxon model, so it comes without a separate legal personality. Similar to the ICAV, easy to establish, no minimum capital requirements, but also be formed as an umbrella. It could be retail or AIF. Also comes with the EU passport eligibility. The general partner may be Irish or non-Irish. It's not subject to regulatory authorization or oversight, but it must be approved, but the directors must be approved by the central bank in advance. It must also appoint an AIFM, like the ICAV. That AIFM may manage the fund directly or may appoint a regulated investment manager in another jurisdiction. Just to mention, Ireland's holding company regime, specifically the absence of a specific participation exemption that's currently being reformed in Ireland. I know from speaking to some US managers that have been recently asking about that. And then finally, just to mention the European Long-Term Investment Fund, or more commonly known as the ELTIF. ELTIF 2.0 is going live on the 10th of January 2024 in Europe. I would say recently there's been unprecedented interest in the revised version of the ELTIF from a wide range of stakeholders. I've seen queries from investors, from asset management clients, but also policymakers and governments are also focused on it, as one of the key objectives is to facilitate long-term investment in the real economy. From an investor perspective, it's important to be aware that the EU Commission has noted that the long-term nature of the ELTIFs will help investors, including retail investors, to make more stable returns and withhold short-term market shocks. The key features of the ELTIFs, they must be closed-ended. They must have a limited duration, which you must set out in your fund documentation. Generally speaking, ELTIF investors are not able to request redemption of their shares before the life end of the ELTIF. That is, as I said, there are some certain exemptions to that. There are rules regarding eligibility of investments, what you can and cannot do, restrictions regarding short selling, the use of derivatives. And just finally, just to close off, that the Central Bank of Ireland has released its consultation on ELTIFs. It was published yesterday. It's going live until December. Just very high level, that the central bank does not propose imposing any additional product-specific rules on Irish domiciled ELTIFs. It says that they can be established throughout the full range of legal structures, so the ICAV, which I mentioned, the ILP, the PLC. The Irish domiciled ELTIF is going to benefit from the same favorable tax treatment currently afforded to other Irish funds, and it will be possible to establish an ELTIF as an umbrella with separate ring face, with separate segregated liability ring fencing between sub-funds, which can have different investment strategies. Look, I know that was a lot.
I'm sorry, I'm going to have to jump in because that's very comprehensive, David, but you've given a phenomenally good overview of the market. Lily, I don't know whether Dave has left you anything there. He mentioned ELTIFs, but there's LTAFs, and would you like to chip in and add to anything David said?
Yeah, absolutely. Thank you. And thank you, David. That's a really good summary. And we're certainly seeing, so sitting here in London with a clean sheet of paper when we're designing a new fund structure, we're certainly seeing a lot more interest in the new Irish options, particularly the ILP, since the reform of that regime. But what we'll normally do is we'll look at sort of where are the investors, where are the investments, and we'll weigh up different regimes and different jurisdictions. So Luxembourg's remains very popular. As an EU fund domicile jurisdiction, there are very similar options to the ones you laid out in Ireland. Sadly, the English limited partnership is not as popular as it used to be post Brexit, but we do still see quite a bit of Jersey, Guernsey, Cayman. And we often, with US managers, will often see a structure that involves multiple jurisdictions. So we may well see a Delaware parallel alongside a Luxembourg partnership, alongside perhaps a Cayman one. And many of you on the call may be familiar with those sorts of structures. Paul Ellison is going to talk a little bit about the pros and cons of setting up a non-EU fund versus an EU fund vehicle, and what that means in terms of your ability to market to widely to European investors. But what I should just, 30 seconds before we move on, there is a UK equivalent to the ELTIF, which David mentioned, and really tapping into this desire to access different pools of capital, particularly high net worth investors, retail, and in the UK, DC pension scheme capital. And the LTAF, so LTAF, they got rid of the E. So this is the UK kind of alternative, I suppose, is up and running. It's live. There are 3 large examples so far. I only mention in case you hear people talking about all these different acronyms. So that's what LTAF means. I'll stop there so that we can make sure we get through the other items on the agenda, if that's okay, Simon.
Thank you. That's excellent. You know, as you say, we've got or you implied we've got a lot of items to go through. But you mentioned your colleague Paul. So Paul, Lily set you up well because we're going to move on to talking about the different distribution channels that there are here in Europe, and maybe touch a little bit on the domiciliation. And the other, Paul, I might ask you to come in after that on how you see your clients, you know, what they avail themselves of in terms of jurisdictions and the distribution channels. But to Paul Ellison first.
Great, thank you very much, Simon. So I'm going to take a little bit of a step back because what we've heard so far is from Lily and David is a fantastic overview of the different types of fund structure available in Ireland or in Luxembourg or in the UK. And some of you might be saying, why do I want any of those? I'm a US-based fund manager. I've got maybe a US domiciled fund, or I've got a Cayman domiciled fund, or I've got a BVI or domiciled fund, or an Ontario limited partnership. Why can't I just get on an aeroplane and talk to an investor in Paris or Denmark or wherever in Europe about my existing fund product? Why do I need to be thinking about using an EU fund vehicle at all? And that's a great question. And the answer for some of you may be you don't, because there are routes to marketing non-EU fund vehicles, non-European fund vehicles into Europe. But it's complicated, as with so much in life. It depends which countries you want to go to and which investors you want to talk to as to what type of rules apply. So let's start maybe geographically where it's least complicated within Europe to market a non-European fund, and that's probably the UK. So if you want to market an alternative investment fund, including a non-European fund, into the UK, you need to register that fund for marketing, and you need to comply with certain UK rules once you've done that. And you can have early stage kind of investor appetite testing type conversations with UK professional and institutional investors before you reach the stage of having to go to the expense of making a marketing registration with the UK FCA. So it is actually pretty possible to just directly market a US or other non-European fund vehicle into the UK, provided you take those steps. Where it gets a bit more difficult is countries that are in the EU. And we're going to come on later to talk a bit about regulations. So I don't want to get too into the weeds of regulation just yet. But there is something called CBDF, the Cross-Border Distribution of Fund Rules. And one of the things that it has done throughout the EU, and it's partly a response to Brexit. So it's kind of, you might say it's aimed at London, but New York and the rest of the US gets kind of affected almost as collateral damage by this regime. What it says is even to do pre-marketing, so even to have those early stage initial conversations with investors, you need to have registered a fund for pre-marketing. And kind of astonishingly, when you think about how international the funds community is, it's not clear on the face of these rules how, if at all, they apply to non-EU funds. And most EU jurisdictions have taken the view that they apply essentially in the same way they do to EU funds, that you can register a non-EU fund for pre-marketing, but a significant number have taken the view that you're not allowed to register a non-EU fund for pre-marketing. And not only that, but that you cannot pre-market a non-EU fund at all. You have to go straight to the full marketing registration. So what, you might say, I just have to fill in one European form instead of a different one. Unfortunately, it's not quite that simple, because what it means is to get to the stage of doing a full marketing registration, your fund documents would need to be in pretty much final form. Your fund vehicle would need to have been incorporated. And as most of you will realize, usually when you want to have your initial scoping conversations with investors around Europe or anywhere else for that matter, it's going to be at a slightly earlier stage in the process. So there is a massive chicken and egg problem, if I can put it that way, in marketing a non-European fund into the EU. And that is driving increased use of European fund vehicles, particularly as parallel funds to invest alongside US or other non-EU fund vehicles, or sometimes actually increasingly as the only fund vehicle, because actually, you know, it's not that hard to market a Luxembourg or Irish or wherever fund vehicle into the US or into Asia. It's the other way around that's the challenge. So this is really driving the selection of EU countries as a fund domicile jurisdiction, because you can register funds, European funds, for pre-marketing throughout Europe, and actually you only need to file your registration with the home regulator of the fund vehicle, because you can then rely on a European passport to make the same filing around the rest of Europe and let the regulator do that work for you. So that is why, or one reason why, so many managers, even non-European managers, are looking at the types of Irish, Luxembourg, other European fund structure that David and Lily have been outlining.
And I'm going to come on to the other Paul, but just maybe Paul Spender, if you can pick this up as well. Are you implying by that people who otherwise would have domiciled in an offshore centre, whether it be the Channel Islands or in the Caribbean, are having to go the full Monty and then not set up in Europe as a result?
Having to is a strong word, but choosing to, absolutely. I think these rules are driving more people onshore in Europe. And maybe I should just there mention another point that some people might have been concerned about, which is that until recently there'd been a lot of noise about the EU potentially restricting the marketing of Cayman funds into Europe at all, even if you go through the full marketing registration steps, because it was on a grey list from an AML perspective. We've now heard that Cayman has been taken off that grey list. So those of you with Cayman structures can hopefully breathe a little bit of a sigh of relief from that perspective, but it doesn't change the more fundamental point about non-EU fund vehicles generally becoming more challenging to market into Europe. And I'm afraid that's probably in some ways at least a gift of Brexit, because it's been part of the EU's response to Brexit and its attempt to bolster up, if you like, the EU border between the EU and the UK.
Thank you. And the other Paul, is that your experience too? You've seen this trend to domiciling and going, as Paul correctly said, choosing, not rather being forced to set up the full European structure in Luxembourg or Dublin or whatever?
Yeah, look, I mean, firstly, it feels like I should apologise for being British and the havoc we've wreaked in our merry way.
Something you do all your life if you're British. Apologise.
Yeah, long list. So, but if we look, I think to Paul very eloquently he's described what I would call the push. So the push is this regulatory framework. And I think sometimes we're a little bit guilty in Europe of kind of, there's a lot to take in. There's a lot of acronyms. There's a lot of, quite complicated legal rules. The good news I always think on that side is that actually the structures themselves, when you look at it, if you're used to using Delaware funds or offshore vehicles, are extremely familiar. The structures themselves operate in exactly the same way. They're exactly what you'd expect to see. Tax treatments are largely the same, similar. So I think that's always a positive. The regulatory framework, again, I think there are means to overcome these challenges, as you can imagine, with a sort of innovative industry that we are, that people have found solutions, host mancos, distribution partners, the concept of chaperoning. So I think the good news is despite all these barriers, even with offshore funds, even with, or even onshore fund with offshore managers, there's plenty of partners and solutions. I think so the regulatory push is one thing. I think, the important thing is the pull. Why are you coming? You're coming for investors. What do investors want? They want an onshore fund. Not always, not every investor, but the largest pool of investors, the biggest, the biggest sort of market you can capture, wants, and because of the way they might distribute onwards, because of the way they treat it on their balance sheet as an insurance company, all sorts of reasons why, because of government regulations guiding how they can allocate markets such as Sweden, all of that is the pull. And I think that's, I think for me, when you're thinking about your target market, thinking who, as Lovin said, who might want to buy this, who's going to allocate, what do they want? And for me, that, because whatever they want, we as an industry here in Europe and overseas can create the solution and the product to meet that need. So I think the good news is always, yes, huge challenges, yes, difficulty, but actually, there are ways of getting to those assets in a kind of cost-effective and timely manner, which I don't think maybe lots of Americans think is necessarily true. I think sometimes they join calls like this, or they speak to some advisors and they kind of think, actually, you know what, that looks like a bridge too far for us. We're going to just sort of, shut that off and maybe pick up some bits and pieces here or there.
Thank you. And unfortunately, at this stage of the proceedings, I have to say something really boring. We'll have to tell the panel who were brilliant and very eloquent to keep their answers relatively short. So already at 20 to the hour, and we've got still quite a lot of stuff to go through. And I see we have 5 questions, so we should try and find some time for those. Lavin, can I ask you for a very succinct and sort of precise, if that's the right way of putting it, way of describing how a US manager can work with a placement agent in Europe?
Yeah, so I think Paul Ellison has already mentioned that there's a chicken and egg problem. We understand the problem and we try to overcome the problem with data. So in the past, what has happened is there was an asset manager in the States, and he was doing a roadshow, traveling over to, let's say, the Nordics, 3 meetings in Helsinki, 3 other meetings in Stockholm, another 4 meetings in Oslo, and then they had probably 20% success rate, which means 2 meetings where LPs have shown interest, and 8 meetings where LPs have not shown interest. So with the pandemic, all the LPs have opened up to video calls. So utilize the technology which is out there. Then we have the data about which LPs like to invest into which asset classes. We have the information which LPs like to invest into the States or have already invested in the States or have available dry powder to invest into the States and also into certain asset classes. Use that information, have an understanding which LPs are currently looking for investment opportunities in the States, and try to tailor your investment opportunity towards those LPs. Then the best way to do this, or the way we actually do this, is that we first have the investor calls via video call, and then we are outlining the ones who show real interest, and then focus on those LPs who have actually showed real interest, and then travel over to the offices of those LPs and provide them additional information. We have done also something which is quite unusual for the European market. We have raised capital digitally, where the LP was in one country, the GP was in another country. They have never met each other, but our AI matching algorithm have actually identified them, and we did the entire due diligence online, and the LP subscribed to the fund also digitally. So try to get the data, and then if you have an understanding which of the countries are suitable for your investment offering, then go to the lawyers and get the passporting and start the fund commitments. One final thing, again, regarding family offices, we have started to work with them. They're super proactive. There are some family offices who already have structures in the States, in Cayman Island, Delaware. They are super flexible in terms of deploying capital in the States directly. But then there are institutional investors who are also coming in with very, very big tickets, and they have certain requirements. A pension fund sometimes can't just deploy directly into a Delaware structure, and you need to have some structures in Luxembourg, Guernsey, or Jersey.
Thank you. I'd love to, maybe later we can talk some other time. Sounds like there's a great idea, sort of dating service for investors and managers. But we'll come. I'm not going to get you, allow you to respond to that, Marvin. Can I come?
Yeah, it is like that.
Can I come to? I'm going to ask in the interest of time, because we've only got a quarter of an hour left, and I'd like to spend a few minutes on questions. Both back to you, Paul, and indeed get the other Paul to comment as well on the regulations. You touched upon them in your previous answer, Paul Ellison, but if you could quickly just talk about the distribution directive, just a very quick word on AIFMD 2, and then maybe straight over to Lily on the SFDR, which she said at the beginning, that's one particular area of expertise of hers, which is a huge, huge, huge issue. So we need to spend some time on that. So in the interest of time, away you go.
Absolutely, thanks, Simon. So the distribution directive, I think we've already touched on in talking about its key impact on the pre-marketing rules. Also worth being aware that there are additional impacts on the contents of marketing materials, whether you're marketing a European fund or a non-European fund. So I would say this, wouldn't I, but worth getting any disclaimers and PPMs that you want to share with the European market reviewed by legal advisors and other professionals. I think then the other thing you wanted me to touch on was AIFMD2. Just when you thought it was safe to get out of the water, or whatever the phrase is from the Jaws sequel, there's another directive. What's AIFMD2 changing? Not as much as some people feared. Some people feared it would really prevent delegation models of the sort that Paul Spendrift touched on in his comments. Fortunately, it doesn't do that. It will have some impacts, though, for funds that engage in loan origination in particular, including risk retention requirements that some of you may be familiar with in the context of securitization vehicles. So some of that methodology coming across the alternative fund space. And then the other thing that it does is to introduce mandatory liquidity tools for more open-ended fund structures.
Thank you. Lily, we could spend a whole hour on the SFDR and where ESG is going, but you've only got a few minutes. Sorry about that.
No, that's fine. So look, SFDR is as you mentioned earlier, there's a whole alphabet soup out there. So this is Sustainable Finance Disclosure Regulation, which we all refer to as SFDR. It has an extraterritorial effect. It's an EU regulation, but if you have a US fund with a US manager and you are marketing to, for example, a German investor, because you've done the national private placement regime route into Germany, that brings you in scope. So what does that mean? I'm going to just talk very quickly about the product level requirements. So all funds that are brought in scope of SFDR need to come up with a response to Article 6. And Article 6 of SFDR says, how do you integrate sustainability risks into your investment decisions? When we talk about sustainability risks, we're talking about risks that have an inward-looking sort of impact on the value of the portfolio. So you could say, we don't consider those at all. But most people don't, because what we're talking about is really, like you were saying, we're ignoring risks that could kind of hurt our portfolio and reduce returns to our investors. So that's the base level requirement. You've got to say something about that. We refer to funds that don't fall into the kind of greener categories of SFDR as Article 6 funds, because they comply with that base level requirement that applies to all funds that are caught. You've then got Article 8 and Article 9 funds. Many of you will be very familiar with this terminology. They have really become used as labels, and that was not what the EU set out to do. This was meant to be a disclosure regime, but we now have investors in the European market saying, I only want to invest in Article 8 funds, for example. So really changing the way they allocate capital by reference to SFDR. So what is an Article 8 fund? It's a fund that promotes environmental or social characteristics. An Article 9 fund is a fund with sustainable investment as its objective. And these categories of fund come with additional requirements. So there are pre-contractual disclosure templates that need to be filled out. They're very detailed, they're very prescriptive. You will need to do annual reporting explaining how you have met those goals that you set out in those pre-contractual disclosures. So getting into these two categories, Article 8 and Article 9, brings additional requirement and cost, but also importantly risk, because you run the risk of categorizing your fund as, say, Article 9, and then not being able to meet those requirements on an ongoing basis. But it also brings a lot of opportunity, because there are a lot of investors that are very keen, as I say, on Article 8 or Article 9 funds. And so we do see a lot of people seeing this as a real positive, and really trying to grapple with SFDR to try to understand how they can best position their strategy to actually fall within an Article 8 categorization, for example. I'm probably not going to spend any more time on SFDR, but I will just mention there's also the EU taxonomy, which is separate. This is essentially the dictionary for how you categorize an environmentally sustainable activity. There are ways that it interacts with SFDR, but it is not a given that, for example, an Article 9 SFDR fund has to commit to have taxonomy aligned investments. So they are separate, but there are certain ways in which they interact. They're the two big pieces of regulation in the EU at the moment that impact funds, including offshore funds that bring themselves within scope. There is going to be potentially some quite significant changes to SFDR. There's a consultation ongoing, and so many of you may have heard about this, but it could result in changes to the labels or categories that I've just mentioned, Article 8 and Article 9. I will probably leave it there. We may have questions. Yeah.
Yeah, thank you, Paul. As in Paul Spendiff, do you get much on the SFDR? Is that a lot of questions on that, and indeed quickly on regulations? And I see the number of questions have gone down rapidly because I think you've been busily answering them.
We've been answering them in the background.
Saving time, yeah. So, good idea. I didn't think about that. Good idea. We should have a sort of formal question answering person to keep answering in the written form. But go ahead. Sorry.
Yeah, look. I think if we're looking again at marketing, right? I think Lily's absolutely right. I think the original sort of labeling sort of scenario has actually become a marketing brand. Is your fund Article 9? Is it Article 8? Investment policy for some allocators is now being built around that. So the question of greenwashing is specifically. So I think all of these things are swirling around. I think and we see some go the other way. I think some firms don't want the onus of being able to evidence, in a quite a sort of detailed way, and maybe opting for Article 6. We've actually seen people sort of underrepresenting their ESG credentials, ironically, because they're overseas. The amount of information they'd need to provide to evidence to the AIFM to allow them to be an 8 or 9 fund is considered to be a bridge too far again, and they've opted sort of out. I think from a marketing perspective, I think what would be clear is you talk about Europe. I think Europe on this as the branding, how to market in Europe. Really, you're talking about how to market into 27 different countries, and I think that plus the UK, plus Switzerland, right? So I think what I would given the limit of time, I would say is that the rules, whilst there is some levels of sort of leveling up through the AIFMD, and that's what was intended. There is the way investors interact, the way money's allocated in different markets, the routes to the investors. Is that through intermediaries? Is that through banks, platforms? Is it through IFAs? Is it through sort of broker-dealer type scenarios? I think what is maybe too much to discuss on today's call is if we go back to the start where we talk about target marketing. Your marketing plan is built around identifying, as Lavin said, those most likely to allocate. And so I think one of the questions was, well, if I've just got a couple of Nordics and a couple of Dutch guys, and I've got a couple of UK guys, and they're all super institutional. Back to Paul's, at the start, maybe or possibly you don't need a European fund. But if you've target marketed family offices, these quick allocators, as Lavin said, and they're in Germany and they're Austrian and they're French, and you probably do. So I think again, I think once you've got your target market, that builds the investor profile. The investor profile builds the type of structure that you're probably going to need to access them and to be attractive to them. And that's kind of, it's not, Field of Dreams will just build something and people will fall into it. I think you need to, as Lily said, start with that blank piece of paper and build up to kind of, or backwards, depending how you look at it, to kind of create, your marketing plan and the support you need around it.
Yeah,
Thank you.
if I can add something to that, Simon. So as Europeans, we believe ESG is important, and you should try to have a focus on that. If you look at certain markets, and if you look at some of our algorithms, if you do not offer ESG investment opportunities, then the Nordics are falling out immediately, because the Nordic pension funds want to see ESG measures within that investment opportunity, because they're also marketing this to the underlying pensioners and saying, we are reducing so and so much in carbon emissions, and they have certain requirements. Having said that, quite a lot of American GPs are actually doing ESG, but they're not tracking it. They're not doing it in a proactive way. It's more in a passive way. And now is the time to utilize technology in order to track this much easier. So any let's say real estate GP who is refurbishing houses and replacing radiators, the carbon emissions are reducing. And this is something you should then track. This is something you should then bring forward to those ESG associations such as PRI or GRESB and work together with them and then proactively market this.
Thank you. We've got 5 minutes left, and I got two responsibilities. One is there's one question Paul didn't answer, so I don't know which one, and we might read out one or two the others. Oh, in fact, I think we did answer. No, actually, here's the first one. Somebody has asked, and this may be rather than a question for you. Actually, I could answer this as well. Is there any data on the number of US managers who have set up in Europe? How many and where they've gone? I'm going to make a very quick attempt to answer that myself by saying that we've launched a thing called the Fund Servicing Tracker. We've literally just launched it in the last few weeks, which is going to be trying to track what US managers are doing in Europe in terms of where they're going, in terms of domiciliation. Are they working with Mancos? What type of service providers? What type of fund structures from a legal point of view they're using? We've got the answers for the first one in this month's issue of our publication, FSI. But Larvin, do you have any data on actually what US managers are doing as opposed to what the market, you'd be talking about what the LPs in the Nordic region or Germany may want? Do you have any, does anyone have any data on the numerous number of US managers and the way they've, you know, are they using private placement? Are they using reverse solicitation? Are they going, as I described it earlier, the full Monty of going to Dublin or Luxembourg? Has anyone got any stats on them? Which I think that's the question.
So we don't have any stats on how many funds have been set up from US managers, but most of the GPs who are working with us want us to utilize the reverse solicitation method to get an understanding. We are doing this in combination with the data in order to narrow down the markets where we can actually raise capital from. And some of the LPs are also sometimes flexible of saying, okay, we can start the conversation, but at one point we will require a feeder fund out of Luxembourg, Guernsey or Jersey, so we can invest. Okay.
Rather than reading out, because we haven't really got the time, but anyone, the panel can see the questions on the screen, I assume. Does anyone want to answer add to the answers that people have already given to the questions on the screen? Otherwise, I can go straight to the poll, which we'll roll the drums for before we get to. Anyone want to say anything about any of those questions?
For the second question, I would like to say that if there are continental European LPs, then the tendency seems to be more Luxembourg in terms of additional structures. If they are UK-based LPs, the tendency seems to be Jersey and Guernsey.
Okay. Anyone else want to say anything before I go to the poll and then do the wrap up? Let's see if this poll thing has worked for a start. Okay, I don't know how many, this says how many people have answered. In fact, maybe it does, 50, 25, 54. The first question, roll the drums. Have you launched a fund targeting EU investors? Yes, 46%, which and no, 54%. I don't know whether you on the panel have seen this as well. Are you looking to launch a fund targeting EU investors? Yes, good Lord, 80%. Have I got this? Am I reading this right? Anyone help me here on the panel? Lily, are you looking at this? You're nodding your head. Can you see what I see?
I can't see what you're saying, but that's a big number.
No. But I think, hang on, I think 54 people have answered these questions. So I think that's all, that's not a bad number really, as an instant poll, is it? No, that's not bad. So maybe my comments at the beginning may have been right. There is still quite a lot of interest in Europe. Well, I think you've done brilliantly well, all of you, to have covered the amount of ground you've covered in only an hour, in fact, less after my introduction. So I'd like to say thank you to Lavin, to Paul Ellison, to Lily, to Paul Spendiff, to David Walsh, and particularly to Okorian for sponsoring this event today, and indeed the series of 3 that we've done, which I think has been really an excellent series in terms of educating the American managers on what is being going on over here. So we promised, I think, to end on the hour, and we've kept to our promise. Thank you very much. So I think it's time to say goodbye and hopefully see you the next time. I'm going to put a slide up, so if anyone wants to email anybody who's on the panel and ask any other questions, they will have their email address. That will go up in a second. Thank you all very much. Have a good morning, afternoon, or evening, no matter where you are in the world. And hopefully see you the next time. Bye-bye.
Bye-bye.
Thanks. Bye-bye.
Bye.
So anyone left? There you are. Here is everyone's email addresses.